Hey everyone, let's just jump right in. Today, we are breaking down a topic that, well, touches pretty much all of us eventually. Sure, it's a slightly morbid subject, but if you look at it from a purely financial and structural perspective, it is absolutely fascinating. We're talking about the business of life insurance. And as we'll see today, the underlying structure of this whole industry is literally a masterclass in risk, reward, and some seriously clever math.
Okay, let's dive into this, because here is the central paradox of this entire explainer. Every single human being dies eventually. The mortality rate for our species is exactly 100%. Now think about it. In literally any other business, if the payout triggering event was absolutely guaranteed to happen to every single customer, the business would collapse overnight. So, since every human dies eventually, how does the house always win? How are these massive companies not just surviving, but generating billions in profit?
Well, to understand the answer, we just need to look at the baseline contract. At its core, life insurance is an agreement that the company pays out a specific amount of money to a family member or beneficiary when you, the policyholder, pass away. But a guaranteed death means a guaranteed payout requirement. So the insurance company has to figure out a way to, essentially, manipulate the terms of that guarantee. Which brings us to Section 1, term versus permanent coverage. Basically, two ways to play the odds. This is the very first major strategy insurers use to mitigate their incredible risk. They don't just offer one type of contract. They operate with two entirely distinct rulebooks. First, you've got term life. This covers you for a set amount of time, usually a window of 15 to 30 years. And here's the kicker. If you happen to die during that specific period, boom, the policy pays out. But if you outlive it, you get absolutely nothing because you're simply no longer covered. Then, on the flip side, you have permanent life. This type actually does pay out upon death, no matter when it happens, as long as you're still paying your premiums at the time. Honestly, term life immediately makes a lot more sense from a profitability standpoint. It completely solves the insurer's massive problem by removing the guarantee that every single policyholder will actually die while they are covered.
Moving right along to Section 2, the math of mortality, actuarial science in action. So for term life, insurers run these incredibly complicated and, kinda morbid, statistical models to figure out death risk. They calculate exactly how many people are likely to die in a given group to appropriately set the premium rates. Let's move to and see how this builds into a very real mathematical scenario. Step 1, imagine a group of 100 people who all buy a term life policy. They each pay $50 a month for a 10-year term. Step 2, the insurance company just sits back and collects all of those monthly premiums over the entire decade. Step 3, the company only has to pay out to the specific individuals within that group of 100 who happen to pass away within that strict 10-year window.
Now wrap your head around this number, $600,000. That is the massive pool of cash generated by those 100 people paying their $50 a month over 10 years. And that's before a single payout even happens. The insurance company has successfully pooled all this capital directly into their accounts. Let's say 25 of those people out of the 100 tragically die during that 10-year term. The company only pays out to those 25 beneficiaries. Mathematically, as long as those individual life insurance policies pay out less than $24,000 each, the insurance company is still turning a pure profit from that initial $600,000 pool. And remember, that doesn't even factor in what the company is doing with that money in the background while they hold it, which is absolutely crucial.
That perfectly sets up Section 3, the secret profit engine. Let's follow the money.
To really follow the money, we have to pivot over to permanent life insurance. Because while term life banks on the fact that most people won't die during their coverage window, permanent life actually guarantees a payout. So how does the insurer win there? Well, by utilizing a true hidden engine of wealth generation. And this brilliantly illustrates exactly how it works. Let's look at a typical policy for a healthy 20-year-old. The monthly premium is about $70 for $100,000 of coverage. If that person pays their premiums every month and lives to be 80 years old, they'll have paid about $50,000 in total premiums over their lifetime. Upon their death, their family gets the $100,000 guaranteed payout. I mean, to the customer, this looks fantastic, right? It's basically a 2x return on the money they put in.
Now, what's really interesting about this slide is the incredible scale of the insurer's return. While the customer doubles their money, the insurance company isn't just letting that $70 a month collect dust in a vault. They are actively, aggressively investing those premiums over those 6 long decades. By utilizing the literal magic of compound interest, even at a modest rate of return, the insurance company turns that $50,000 in premiums into several $100,000. So when it finally comes time to hand over the $100,000 payout, they do it with a smile.
because they've made exponentially more than that by investing the customer's money in the meantime.
But compound interest isn't their only advantage. Let's move to Section 4, lapses and fine print, leaving money on the table.
Here's where we see how customers end up leaving serious money on the table. These are the highly effective and slightly more cynical ways permanent life insurance companies retain vast amounts of cash without having to pay a dime in return. The biggest one? Lapsed policies. Look, over the course of 40, 50, or 60 years, people's financial situations change. Sometimes they just stop paying their premiums and move on. When this happens, the policy lapses. The insurance company gets to keep all the money that the customer paid up to that point as pure profit. And because the contract was broken, the insurer is completely released from their obligation to ever pay out the death benefit.
And then we have this minor but incredibly impactful strategy: sneaky clauses. At the end of the day, insurance companies write the rules, and they purposefully put very specific terms and clauses into their contracts. These basically act as legal loopholes to get out of paying death benefits in certain fringe or unusual scenarios. It's just one more layer of protection that helps ramp up their profit margins just a little bit more.
So, let's bring the whole shebang together and quickly summarize exactly how insurers win. They set strict term limits so they don't always have to pay. They charge precisely calculated higher premiums based on complex statistical mortality formulas dictating who will die and when. They invest your money over decades to harvest massive compound interest. They keep the cash from lapsed policies, and they utilize sneaky contract clauses for those weird fringe scenarios. All of these tools work in total, perfect harmony to ensure they keep their payouts as low as mathematically possible and their profits incredibly high.
Seeing all of these structural advantages stacked so heavily in favor of the insurance company naturally leads us to the most obvious follow-up question. If they always win, and if the system is entirely calculated to benefit the insurer, why get life insurance at all? Why do millions of consumers willingly participate in this system every single day?
So, the crucial point is this: if you don't live to be 80 years old, you will have paid significantly less in premiums, making your personal return even better. Life insurance provides a safety net against the completely unexpected. If you tragically lose the mortality gamble early in life, your family receives a massive, life-changing payout that far, far exceeds the small handful of monthly premiums you paid into the system. You are essentially hedging against worst-case scenarios, protecting your loved ones from total financial ruin.
Which leaves us with this final, somewhat provocative thought. Who is really winning the mortality bet? Well, the insurance company uses the immense scale of time, data, and compound interest to pretty much guarantee their financial victory. But for the individual, it buys peace of mind and absolute protection against the devastating financial timing of an early death. It is a perfectly balanced, mathematically brilliant ecosystem built entirely around our shared mortality. Thank you so much for joining me for this explainer today. I really hope this breakdown completely changes the way you look